Looking ahead to the Fed, the central bank's most recent move might have been priced in, but Fed leaders expected to weigh in several times during the week to help telegraph where the economy is headed. Joining us with more, we've got Liz Young, SoFi Head of Investment Strategy. Liz, great to speak with you as always and get some of your insights and perspective. All right, highly anticipated is what the Fed's last move was. But now as we start to look out even further into next year, perhaps, when do we believe that they might begin to curtail some of their policy pathway that they've set forth on?
Yeah, the picture gets a little murkier into next year, doesn't it? But that's what keeps it exciting. So you're correct. This past move was highly anticipated. I think everybody expected 75 basis points. And actually, the meeting in December is the one where the question marks begin, because that's when the expectation starts to be that they could possibly downshift on their path of rate hikes. Now, one of the things that I think has been interesting this year and maybe perplexing to me has been the market's sort of resistance to listening to what Jerome Powell has said. So I would really try to take what he says into account. And he reiterated the message again this time that, number one, they are far from pausing. It would be premature to pause, and that inflation is still their number one issue and their number one priority. So until we see consecutive months of inflation coming down in a meaningful way, I expect them to continue hiking and continue tightening. And I think that they are quite comfortable with tightening maybe a bit too far and then trying to sort of ask for forgiveness from markets later with the tools that they have to stimulate.
Liz, you think there's just too much hopium pumped into these markets here?
Hopium, I love that word. I think that there is optimism pumped in because we've had such a tough year. Investors have had a really hard time, both in the stock market and the bond market. And we've been looking for a reason to feel more optimistic and a reason to believe in durable upside on the other side of that sort of abysmal 2022. Now, I do think that we probably, if we weren't sure that we would go into a recession, we may have gotten a bit overextended on the downside. But because at this point, a recession, even just consensus, has a 60% chance of a recession in the next 12 months, a recession is pretty likely at this point. Doesn't mean it has to be bad. Doesn't mean that it has to be Armageddon. Recessions reset the business cycle, and that might be a positive in this environment. But because it is getting more and more likely, and we're hearing more revisions downward in earnings, and the expectations for 2023 earnings are now possibly for a contraction over 2022, the market likely has to bake all of that back in.
Liz, yeah, I'm glad you mentioned earnings. We were just talking about a Goldman Sachs note out this morning, looking for a potential in a recessionary environment, an 11% decline in S&P 500 earnings. But do you think that's even too conservative?
Well, you have to look at it from a sector perspective. This is a situation where I don't think every sector is going to get hit the same, particularly because of what's happening with inflation. And if you split inflation up into goods inflation and services inflation, goods inflation is likely to come down much more quickly and to a more manageable level than services inflation, which tends to be more sticky and includes things like rents, and businesses are also dealing with sticky wage inflation. So the sectors that are goods intensive and can benefit from goods inflation coming down and commodity prices coming down are likely to do better and maybe don't take as big of an earnings hit. The sectors that are very labor intensive and are dependent on services might have a bit more pressure, particularly because as inflation falls, so does revenue. So the margin between revenue and that bottom line narrows quite a bit. So it could be a pretty big dispersion by sector. So if the sectors that get hit limit that earnings hit to only 11% down, I think that's reasonable. I would expect something like a 10 to 15% contraction in earnings. So I actually think 11% is pretty reasonable.
When you think about what a real recession would look like and the best investment strategy to employ in that, what does that look like from your perspective? Where should people, investors, be leaning into?
So I always think of it this way, and I feel like I say this over and over again, and I always feel like I'm repeating myself, but the market goes first. So the market has cracked this year, and the market has shown us its pessimism. It's shown us its reaction to the macro environment. I think the piece of it that hasn't quite been priced in entirely is that earnings contraction. Earnings go next. So earnings are the next thing where you might enter what's called an earnings recession. And if you take energy out of this equation, we're actually in an earnings recession right now. But if we look ahead to 2023 and earnings are going to contract, then the last piece of the puzzle is that the economy falters. And you see real data in the economy, the labor market, inflation comes down, that things are actually contracting. But that's the last piece. By the time we get to that, the market has likely started to recover. So if you are an investor in this environment and you have a longer term time horizon that can last through the end of a business cycle and into the next, this is a time when you start to look around and say, what's attractively priced? I would be looking at sectors like healthcare, which can still offer some growth opportunity, but are much more attractively priced than, say, the really growthy areas of the market like tech and communications that are still under pressure. You can look at things like financials, which are very attractively priced compared to the index. You can look at industrials because at the beginning of a cycle, if you're trying to position yourself for that, the cyclical aspects do tend to lead. And you can look at things like small cap. So this is a time where you want to start to build positions that are priced well for a valuation pressured environment, and you want to wait it out and let them come back. And look, buying 20% down in a market is better than buying at the top. So you're not going to catch the bottom, but a lot of things are at a pretty good discount right now.
Liz, last week we talked to your CEO, Anthony Noto, and you guys said SoFi had a really good quarter, especially in investing products. What are you hearing from investors when they come to the SoFi's platform right now? What are you being asked ahead of 2023? Because this year has been really, really challenging.
It has been really, really challenging. And I think a lot of investors, especially on our platform, because we do skew to the younger investor, more than 60% of our members are between the ages of 20 and 40. So a lot of them are really just experiencing this for the first time. Maybe COVID was their first real recession. Maybe it was their first big bear market. This is now a bear market that's in a more normal situation. So there's some fear there. But the interesting part is that we conducted a survey of our members, and almost 75% of them said that they planned to invest just as much, if not more, over the next 6 months, despite volatility in the market. So I find that very encouraging, and I find it encouraging that people are learning through this cycle and learning that this is a natural part of being an investor. This may be the first bear market they've seen. It certainly will not be the last. And I think that our investors still have the intention of being engaged in markets, which I think is really great.
I very much I still fall in that age range of that latest survey. We'll leave it there. SoFi Head of Investment Strategy, Liz Young. Good to see you. I'll catch you on Twitter, my friend. Talk to you soon.
Thank you.